Investors are pulling out of the housing market at an alarming rate, completely halting their purchases of homes in the US and in some cases starting to sell off their portfolios over fears of steeper housing market declines in the future. And the most concerning thing of all is that it's the largest investors that are pulling out of the market at the fastest rate, with the home buying activity amongst iBuyers and large institutional investors down 80%, according to John Burns' research. One institutional player that has stepped away from the housing market is Yield Street, the private market investment company that has over $3 billion in assets under management. And one of their directors recently stated that they don't think house prices have bottomed yet and expect a further 5% decline on a national level, which will vary by market. Now, Yield Street own over 700 single-family homes, but have been on pause across all of their home buying strategies since December last year and have not bought a single home since then. And this is despite the company wanting to grow their single-family home portfolio from its current $200 million in value to being at $1.5 billion over the next 5 years. Yield Street's actions really do speak volumes here, and their refusal to buy any homes so far in 2023, despite the company's strategy being to more than 7x their portfolio size in the next 5 years, shows just how overvalued the housing market is right now and how poor of a return on investment they think they would get right now. Yield Street is ultimately expecting the housing market to fall by 12 to 15% peak to trough at a national level, and we are still a long way off reaching that sort of decline just yet, looking at today's Case-Shiller Index reading. We've also recently seen Blackstone, the largest institutional real estate investor in the US, come out with a poor Q1 earnings report, with earnings dropping by 36% year over year due to the real estate slowdown. Now, Blackstone has also seen investors losing faith in their flagship real estate fund, BREIT, suffering from $4.5 billion in withdrawal requests in March, and this is a significant portion of the $70 billion fund and signifies a 15% increase in withdrawals from the month before and the 5th straight month that the firm has been forced to limit redemptions at 5% of the quarterly net asset value of the fund. Interest rates being really high right now is also a factor behind a slowdown in institutional investment into single-family homes and other real estate, and it's much harder to raise capital for deals, while at the same time existing investors are pulling their capital out from largely overpriced real estate with average yields and instead choosing to opt for the slightly lower yields they can get in much safer assets like government bonds or just money in the bank earning interest. But overheated house prices are not the only reason why investors are being scared away right now from buying more homes. One of which is a declining rental income over the last 6 to 12 months, meaning that each home is generating a reduced amount of cash on average every month. The median rent price has fallen from $2,053 a month last summer to now being $1,937 a month, a 5.7% drop in a relatively short space of time. It's fair to say though that the median rent has surged since the pandemic started, and even after this recent fall that we've seen, it's still a whopping 20% higher than what we saw in March 2020. The current state of the economy will also be a contributing factor to the direction that the rental market is heading in, with inflation still being pretty high, recession fears still being very real, and companies continuing to make layoffs every month. We've already seen layoffs across many multinational companies, including all of big tech, and this trend is only likely to continue into the future. Unemployment has historically lagged behind interest rates by a few years, and right now we are still at an extremely low unemployment rate historically, meaning that over the next couple of years we are very likely to see the unemployment rate surge across the US to catch up with the sharp increase in interest rates over the last year or so. With more people being laid off and unemployment rising in the future, we are likely to see an increase in people living with parents and other family members or living in shared accommodation, all of which will reduce the demand for rented accommodation and put downwards pressure on rent prices. So it certainly looks like we could see rent correct further in the future, which would of course make real estate a less attractive investment given the lower return on investment. The short-term rental market is also not looking too good at the moment, with the current oversupply of properties on the Airbnb market and authorities imposing tougher restrictions on hosts in some areas really impacting this market. The downfall of the Airbnb market is forcing landlords to lower their rent to compete for customers in the market, or to just sell up altogether due to fears that their return on investment will continue to decline further on. Another major thing that is making investors very concerned about the housing market is the glut of homes currently under construction that will be hitting the market in the next few years. Housing units under construction for both single family and multifamily units are both at astronomical highs right now. So starting off with multifamily homes, the number that are under construction has just totally exploded in recent years to a level that we have not really seen before. The current number is far higher than the peak that we saw in the global financial crisis, and you'd have to go back until 1973 to find when it was last this high. The number of single-family units has taken a slight dip over the last year, but the number of units still under construction remains way higher than what we've seen over the last decade, now at highs seen during the global financial crisis. And looking at larger multifamily units in particular, the number of multifamily units consisting of 5 or more units that went under construction, as well as the number that were completed, each rose to the second highest level in more than 30 years in February. Now, completed residential projects surged by 72% year over year on a seasonally adjusted basis to 509k, the highest level that we have seen since 1987, with the exception of February 2019. And started projects rose by 14.3% to 608k, the highest that we've seen since 1986, with the exception of April 2022. Now, this number of homes under construction right now is elevated due to a number of different reasons. Supply chain constraints over the last couple of years is one, however, greedy home builders is also another one. Now, these homes began construction over the last couple of years when the housing market was rising every month, and home builders realised just how much profit they could make by pumping out as many new homes as possible. Well, now the housing market has turned and home prices are falling, the home builders have still got to finish off building these homes and will have to offload them all into a weakening market, which could just exacerbate the downturn in home prices. The combination of declining home prices and homes under construction being at historic highs has clearly got the major home builders concerned about the prospect of making new home starts at this current moment in time. The number of housing permits issued in March was down 8.8% from February and down 24.8% from a year ago, down to 1.41 million. And although the number of homes under construction is still extremely high right now, home builders are pulling right back on making any additional housing starts. This is reflected in a fall in housing starts in March, down 0.8% from February. Now, March typically shows a rise in housing permits and starts, however what we are seeing this year is the complete opposite. Home builders are certainly holding back due to fears over housing affordability and where the market will be in a few years' time when any new home starts today would ultimately be finished and ready to sell. D.R. Horton, America's largest home building company, recently had their earnings report for Q2 of 2023, and there was an alarming fall in their sales order backlog, which fell by 44% year over year. In monetary terms, their sales order backlog has fallen from $13.3 billion last year to now being at $7.4 billion, and marks the largest drop we have seen in this metric from quarter to quarter. This fantastic chart from Nick at Reventure Consulting shows how bad this looks relative to historic numbers, and it's really starting to look like we could see the pattern replicate what we saw at the start of the global financial crisis, where sales order backlog also just fell off a cliff completely. With all of this being said though, looking at more real-time housing market data, we are seeing some very strange and alarming things starting to unfold. The market could be turned on its head soon, and I cover all of these very interesting metrics and data points in my recent video, which you can check out by clicking on the screen right now. Aside from that, please leave a like on the video if you enjoyed it, subscribe if you want to see more, and thanks a lot for watching.